Brian Grimes, your real estate mentor, back with another action-packed session. Today, we're going to be talking about buy and flip versus buy and hold real estate. Which strategy is the best and why? I get this question a lot from you guys. Should I be buying and flipping? Should I be buying and holding? How do I know what strategy I should do? Should I be mixing them up? So we're going to talk about the pros and cons of each strategy individually, and then we're going to put them one versus the other and see which strategy makes the most sense for you. Having this understanding is going to help you to scale to the next level and help you to accelerate faster. If you're new to the channel, like, comment, subscribe, leave a comment that says I subscribe. For everybody who leaves that comment, I'm going to send you instant access to one of my free real estate trainings. It'll show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on that free offer. If you want to join us on the YouTube channel, just click the links in the IG stories and you can tap into the YouTube channel where we're sharing this full presentation as well. Guys, if you're interested in any of our programs, the Boots on the Ground program, that's where we find, finance, rehab, tenant, and manage cash flowing properties for you. So we do it all. We source the deals. We're building properties for you in the Philadelphia market. So if you're out of state, like you're in California or Canada, out of the country, and you want us to build houses for you that will cash flow, where you can do the burst strategy, put your money in, renovate, refinance the money out, put it back in the bank, back in your pocket, and keep the property in cash flow, reach out, DM me. We have very limited capacity. We just had 2 people join over the weekend. So we're at extremely limited capacity there. So definitely reach out. If you want to tap into our real estate ride-along tour, I think we only have 1 ticket left and it's sold out. It's completely sold out. So that's going to be going down on Saturday, May 18th. We're going to tour about 10 to 15 projects that we're working on. We just kicked off 3 or 4 more projects this week. So there's a lot of action there. Come spend a day with me in Philly, in these properties. We're going to stand in properties together. I'm going to teach you guys how to put them back together, what the cost of construction is, all that information. So that will accelerate you. And if you just want to do it yourself, you just want access to the course content and the knowledge, you can always reach out, DM me, text me, email me, click the links in the description, and you can get a hold of me and my team. We're happy to connect. And some people are surprised, but I'll hop on the phone with you one-on-one and talk to you about this stuff and see if it's a good fit. All right, let's get into the mindset. So the mindset for today is multiple strategies. You got to have multiple strategies if you want to win. A lot of these talking head real estate gurus, they're going to try to pitch you on one strategy and say, look, you got to go Airbnb. You got to go tax liens and tax certs. They're going to give you one strategy. They're going to put it above all other strategies and tell you that once you master this, you're going to be good. Everything else sucks. And it's a complete lie. You need multiple strategies to be able to win in today's game because the market is ebbing and flowing more than ever. It's changing more than ever since really, the shutdowns in 2020. It's just been changing up and down. Rates are jumping up and down. You need a couple of different strategies to be able to navigate most markets. If you're in some of the top 10 cash flow cities, you can buy and hold, but a lot of you guys aren't like we are. And we're building in Philly, which is number 7 on the top 10. But to me, it's the best of the top 10 because it's the most developed and it's the sister city to New York. New York's the city of the world. So you don't get better than that. That inflow of traffic from a high price market coming into your market, driving up rents, driving up prices. You can build cash flow in a market like Philly. So if you're looking for passive income, Philly's going to be that hit to me. And then Baltimore or Cleveland, I would probably go Baltimore, then Cleveland if it was me. And that's what I'm doing. And we're going to open up Baltimore at some point to the Boots on the Ground program and the Boots on the Ground members. But you have to have multiple strategies if you want to win. And that's why today we're talking about buy and flip versus buy and hold. We're going to compare these two strategies to see what makes the most sense for you. But within our course content, we offer we talk about really 6 to 7 core strategies: creative financing, short-term rentals, mid-term rentals, co-living, Section 8, buy and hold, buy and flip, wholesale. We're talking about all of it because you need a lot of different strategies to be able to accelerate to the next level. Ruben just tapped in. He said, yeah, I just joined the Boots on the Ground program today in the IG channel, day after his birthday. So you guys wish him a happy birthday. Part of his gift to himself was tapping into the Boots on the Ground program, investing in his future. So let's talk about some of these strategies, guys. If you have questions, comments, drop them in the chat section, drop them in the comment section. We will stop to go through them. But let's get the ball rolling here. All right, let me go over here. So buying and flipping versus buying and holding. Which one are you going to do? Flip or hold on tight to these deals? For me, I'll preface this with I'm a developer, right? And I built over 300 properties. I've never not regretted selling a property. I dropped a Instagram reel and a YouTube. I'll drop it on YouTube as well, where I talked about flipping a house for 50K and how I needed that 50K. I kind of regretted doing it afterwards, but I needed that 50K to accelerate. So there's a time and place for flipping. But as a developer, as a long-term focused investor, you're not going to be in love with flipping. But flipping can provide you the capital to do more deals. So if you guys know me, I'm always like, hold it, hold it, hold it. But there's a time and place to flip. And we're going to talk about the time and place. And if you're in a market where that makes sense. So just drop your questions as we go through. So let's do the pros and cons of buying and flipping. Here are the pros. There's a short-term commitment. You're not locked into this deal forever. You're typically going to factor in about 4 to 6 months for a flip, 2 to 3 months to build it, and then a couple of months for it to sit on the market and sell. How long is it going to sit on the market? It really depends. You can go on websites like Redfin and you can check the time on market, the average days on market for these different properties that are out there. And you can see not only what properties are selling for and how fast they're selling in certain cities, but you can also get zip code specific. And I would recommend as you're doing your flips, you get very granular, you get zip code specific, because one zip code properties may sit on the market for 30 days to 60 days. The other zip code, 90 to 120 days. So you really need to make sure if you're going to flip that you're doing this in the right pockets. 2, you have more market options, which is a pro. So if you're in a priced out market like California or Colorado, you're on the West Coast, you could still flip hypothetically because there's no cash flow in those markets because the market is overinflated, because prices are high. If prices are high, flip into that. If you can find a deal cheap enough from a wholesaler or directly from a motivated seller, you're going to have a spread where you can build and flip. So you're going to have more options in terms of markets that you can flip deals in. You just have to do your research. You have to know how to do your market research. It's something that we teach you within our course content, my strategy for researching markets. And my claim to fame is you can drop me out of a parachute anywhere in America and I could do a deal. Give me 30 days. I'll grab contractors, architects, engineers, lenders, and I'll be able to execute on a deal. So if you learn how to flip and how to get comfortable with pulling your comps, you're going to have more markets that you could tackle because there are more flippable markets out there than cash flow markets. There are limited cash flow markets. And I recommend focusing on the top 10. And you guys should know what those top 10 are. So we have that. You can maintain liquidity with flipping. So as you're flipping, you're not locking up your money long term. Now, when we're doing things like the burst strategy, we're typically getting our money in and out of the deals. So we're also not locking up our money. The burst strategy is kind of this mixture between flipping a house and keeping it. We call it flipping the house to yourself is the burst strategy. So you can still maintain some liquidity within the burst strategy, especially at lower interest rates. As rates go back down into 2025, 2026 even, you're going to get cash out refinances, which means you can flip properties to yourself and increase your liquidity. But for the flip strategy in particular, because you're not locking up your money, you're always getting access to that equity buildup, that sweat equity. You're going to maintain your liquidity. And then the last is you're going to get upfront profit potential because you're getting all of your money from day one. If you think about it, when you're buying and holding a house, you're getting your money kind of dripped to you over the course of time. So you're getting the rent's $1,500 a month, maybe your cash flow on $500 a month. So you're getting your money in $500 increments. When you flip it, you might just get 50K. So it's the equivalent of getting like 6 years or 5 years worth of cash flow all up front. And that's what you're looking for on your flip deals. The cons, taxes. You're going to get taxed. You're going to get crushed with taxes. Whatever your ordinary income tax is for your state, that's what you're going to get hit with. And this is bad if you're already in a high tax bracket. So some of you guys have capital. You're high earners already. You're sitting there. You're like, I got $250,000 over here. I can flip this in the market. but you're going to get hit at the highest income tax bracket. So you're not doing an investment strategy that is tax sensitive. If you are a high earner and you're getting hit with taxes, you should be thinking about tax sensitivity. Market sensitivity. When you're flipping, you're very susceptible to market fluctuations. So if you're in a hot market and it crashes, it has a flash crash, or something happens that shocks the market, like they kill Airbnb and it dumps a bunch of properties on the market, that can have a major impact on the profitability on your deal. You have no passive income. You have higher rehab costs. So as you're going to build this property, you can't do things like play the appraiser game. This isn't about an appraiser walking in and saying, hey, some properties around this sold for, XYZ. So this property must be worth 225 as well. You're dealing with the market. So you have to go the extra mile in terms of putting in more capital into the deal to give it the strongest chance of selling. So you have to typically do a higher level renovation than if you were holding the property and you were able to cut some corners. And then you could have more unanticipated expenses because you have to get it right. It's not like a rental property. A rental property, you can cut corners, you can make different decisions. With a flip, you have to get it right before you put that on the market to go sell, because typically the buyer is going to bring in an inspector, a certified, qualified inspector, to look at that deal and try to pick it apart. So those are your pros and cons with your flip deals. Let's get into the buy and hold pros and cons. So the pros of the buy and hold alternatively are you're going to build up passive income. This is huge if you're looking to break free from the 9 to 5. You don't like to hustle and bustle and kind of, work nonstop. You're going to like getting that passive income. With the flip, you have to keep hustling. So even if you're making 50,000, 60,000 on this deal, you only eat what you kill. With the whole strategy, you're getting paid over and over again for what you did, not for what you're doing. So you have to keep this in mind as you're looking at your investment strategy. How long are you going to have to put this level of energy into the real estate? If you're getting older, you need a passive income stream. You may be doing a mixture of both, but you need a passive income stream so that you're not just kind of constantly hustling until you burn out. 2, on the buy and hold side, you're going to get massive tax write-offs. You can get bonus depreciation, ghost depreciation. You're going to get some really nice tax write-offs that you are not going to get with the buy and flip strategy. The rehabs are typically faster. On the buy and hold side, I've had rehabs in the boots on the ground program going about 4 weeks. On average, I always tell you guys 10 to 12 weeks for a cosmetic renovation. But I've had rehabs going 4 or 5 weeks. Like so fast, I almost missed it. It's like, hey, did we start that project? They're like, bro, we're done. We're on to the next one. Whoa. So some of these buy and hold projects can go really fast, and that can be a pro, especially if you're new to the game, you're just getting started, and you don't want to be in some long rehab. Appreciation. This is what hurts you when you're flipping. You flip this house. You're like, hey, I bought it for 100. I sold it for 150. I made 50 G's. I'm the man. And then you come back in 5 years and that property's worth 250. And you're like, damn, I just missed out on $100,000 of appreciation. You're missing all the appreciation when you're flipping. So, that's something that you need to be aware of. That appreciation buildup is high. And I will say this, I've been telling people this, in a market like Philadelphia, I would anticipate all properties, from what I'm seeing, even in the hood, from the hood all the way to the nice areas, they're going to appreciate, almost $100,000 each, which means if you're buying in the C-class neighborhoods right now and holding, and you got 5-10 properties, you could appreciate $1 million. Like this is crazy because you just be holding on to the properties and cash flowing the whole way. So you're making $500 a month, collecting your cash flow. Time goes by, and you look at the market and you're like, hey, Brian, what do you think this property's worth now? Oh, that's worth $275. Whoa, I was all in at 150, 160. So that's going to happen to a lot of you who get in the game and really hold on to these properties. I've had properties that I purchased triple in value in 10 years. Like, it will happen because a market like Philly is not overpriced yet. It's not overheated. So you're still getting in early. Even though there's a lot of development You're getting in early on these markets. You'll be getting in early on a market like Baltimore as well. Bonus depreciation we talked about. That's a big major pro. Some of the cons: tenant management. You got to manage your tenants, and some people, some of you don't want to manage tenants. I mean, you could get around this con by just getting property management in place. If you're in the boots on the ground program, we'll manage it for you at 5%. So we're doing that. But that can be a con. Slower profits. There's definitely slower profits, like we talked about. You're getting your money dripped to you $500 a month instead of $50,000 in one hit. There's deferred maintenance. So when you typically go into a deal, a buy and hold, if you do it the right way and you do a burst strategy deal, you're going to buy it. You're going to put in a heavy renovation, 60, 70,000, try to really get it tight. So there's not going to be a ton of work that you have to do. But over the course of time of holding these properties, there can be deferred maintenance. There's going to be years where you got to go in. You know what? You got to put in new flooring. That's $4,000. You got the heater blew out. You got to put in a new heater. It's $3,000, $2,500. There's going to be some times where some of this stuff happens. So just know that that's there. And then there's interest rate sensitivity, but that's only in the short term. That's only while you're locking it into a 30-year. If rates go down, you can always refinance into lower rates, but you do have interest rate sensitivity on your cash flow. Now, as rates have risen, what I've seen is rents have gone up. Rents have inflated with interest rates. So it's offsetting the higher interest rates to the degree that it's almost like a 4% or 5% interest rate mortgage relative to the cash flow that you're getting today. So keep that in mind. You're getting a lot of cash flow. Rents will go up, but you do have some more interest rate sensitivity, or it's something to think about as a con. You don't really have that sensitivity as much on the buy and hold side because you're not holding it, but it still exists because as rates go higher, people can afford less of a deal. So then your profits can get compressed. So I would put it in market sensitivity on the flip side. On the hold side is truly not the market you're concerned about. You're just concerned about rates and cash flow. Once you lock it in, unless rents just completely nosedive, you're gonna cash flow at a high level. What's the best strategy? And then we'll get into some of the questions that have come in. Guys, keep the questions flowing because I'm going to turn to the questions shortly. So keep your questions coming. If there's something on your mind, drop the question in the chat and we'll flow through it. What's the best strategy? Should I flip or should I hold? Well, it depends on who you are. If you don't like managing tenants, you'd like to have all your profits up front. Or you're investing, some of you are investing out of state and you're not ready to be locked into the state yet. You're like, hey, I'm investing out of town because I know the properties are cheaper. I'm in California. I'm doing some deals in Texas, but I'm not really ready to be locked in. Like I'm a commitment phobe, essentially. Flipping could make a little bit more sense because you're not really locked in. If you're in a low tax state, or if you personally are at a low tax bracket, flipping could make sense because you're not going to get hit as hard on the tax side. If you're trying to build up your capital, if you're just getting started and you're like, Brian, I got 20 grand, 25,000. I want to take on a hard money lender and do a flip, something small, but I want to build up my war chest. I want to build up more deals, more capital to do more deals. Flipping can make sense because you can flip your money up, or wholesaling could make sense where you could mark deals up, take down commissions, build up your war chest, and then you can deploy that into the whole strategy if that's what you really want to do long term, but you don't have the capital yet. And if you're just a shorter term investor, if you're just about the money today, you just want to make your money go buy a Lamborghini, I ain't mad at you. I'm not going to do it with you, but I'm not mad at you. Flipping might make a bit more sense. If you're like, hey, I like the fast cash. If you're looking at real estate versus crypto, you might want to look at it as more of a flipping strategy, unless you're looking at the real estate as a conservative diversification tool for your crypto investing, something like that. Flipping has its time and place. If this sounds more like you, I'm all about appreciation. I want to see my value go up, my net worth increase long term. I want the tax write-offs. I'm tired of paying taxes. I want to pay less taxes. I want more tax write-offs if I can get them. I want to be on the right side of the tax code. By the way, guys, the tax code was written for business owners and landowners. I want to be on the right side of the tax code. I'm a holder. I want to generate more retirement income. passive income, for a fixed income, a retirement, definitely hold. Definitely don't want to be flipping because of the risks. I want to recycle my capital. I have, 50 to 100K. I want to get into the burst strategy, put my money in the deal, renovate it, put the tenant in, refinance my money back out, and recycle my capital in and out of deals and acquire wealth for the next generation. You're definitely a holder. And then if you're just a long-term investor by nature, if you're buying and holding stocks and you're investing in ETFs, you're probably a buy and hold real estate investor as well. It's highly doubtful that you're going to come in and start gunslinging flip deals. So to me, the best strategy is a combination of the two. There are going to be times where you have a deal and it's a good deal and you could hold it, or you could flip it and unlock 50 to 100,000 and then take that money and dump it into a hold deal, because the taxation that you create from the flip, you can offset with the bonus depreciation and tax write-offs that you will get from the hold. So a really good combo strategy is maybe like one flip for every 3 holds. And the money you make from the flips, you park it in the buy and hold deals. That can put you way ahead of the pack. So keep that in mind. Guys, coming up next, we're going to have a session on Wednesday, May 1st, 12 p.m. Pacific time, 3 p.m. Eastern Standard Time. I'm going to be going live with Min and the What's a Mortgage family. We're going to be doing a closing cost and hard money breakdown. So if you've been confused about, hey, what is hard money? How does it work? How much money do I need to bring to the table to close on a renovation project in the burst strategy? Can I do a deal with 15K, 10K, 20K? The answer is yes to all of the above. You can't really do a deal with 5K. I've done a deal with 5K before, but you have to build up your relationships to that level where you can get that level of funding and have it designed in a way where it makes sense. But yes, you can take 10, 15, 20K, get a construction lender, and you can get a deal done, a burst strategy deal that you can buy, hold, and cash flow for a long time. We're going to talk about those closing costs and a hard money breakdown. So if there's any confusion, you'll be unconfused by the end of that. Let's get into some questions, guys, and we'll flow through some of these questions and then keep it moving. We said, hello, I have my appointment for a chat on Wednesday afternoon. Looking forward to connecting with you then. Do you have a date for the ride-along in June? We will not have a ride-along in June. The May 18th is the summer ride-along. We might not have another ride-along this year. So you definitely want to grab tickets to this ride-along. If we have another one this year, it's not going to be in June, July, probably not August either. So definitely this is the ride-along to attend. This will be our 3rd ride-along this year. This is the most ride-alongs we've done in the year. So definitely tap in. Aiden said, just found your channel and don't mean to go off topic, but what are the pros of not paying off a rental property? That's a great question, Aiden. And it's not, in my opinion, off topic. Not paying off the rental property, here's a better question. What's the benefit of paying off the rental property? Well, if you pay off the rental property, you will not have the debt. You won't have the stress of the debt. So that could help you out a little bit. Hey, I'm less stressed out. I'm feeling good about this. Your cash flow on that property will increase. As my mentor says, as he's gotten older, he's appreciated having less debt per property, per asset, and more cash flow per asset versus more assets for a similar amount of cash flow. It can be less stress, especially if you're self-managing. So it just takes the stress off the table. It also takes a lot of tax losses off the table because you're getting mortgage interest deductions. You're getting different levels of depreciation. You're going to take some losses off the table that the tenant would be paying otherwise. And you're parking your capital in a deal where you could be using that capital to go get more assets. So it kind of hurts your family, in my opinion, long term. If you have a good strategy, conservative strategy, and you can manage these properties successfully and have the tenants pay them off over the course of 30 years on a 30-year note, you'd be better off acquiring more assets for your family to inherit that's going to appreciate in value versus having less assets. So less assets, more comfortable for you, but in my opinion, for your family to inherit, it's less value. Your kids will smack you on the back of the head maybe and say you should have grabbed us another 50 houses versus being so conservative. But 6 in one hand, half a dozen in the other. What do you think about buying foreclosures? Buy them. I mean, they're good to buy if you can get your hands on them. I'm negotiating some bank-owned properties for our Boots on the Ground members right now. So I have a portfolio of bank-owned properties that I'm negotiating for us and getting us tapped into right now. So I don't see anything wrong with that at all. Is real estate investing stronger in profit than the stock market? Why? Yes, it is, especially the burst strategy. The average burst strategy deal that I see in Philly has a cash on cash return projection of 100%. That's like on average. The cash on cash return is 500%. Infinite. You have no money in the deal. The returns are much higher. The average stock return, 10 to 12% long term. That's like industry standard. If you take a stock out long enough, and unless it's like one of these hyper growth stocks, but even if we take them out long enough, average return 10 to 12% annual, because there's going to be big ups and then crashes. It's going to balance itself out. So pound for pound, do you want 100% or 10% on your money? While I'm getting the 100% on my money, I'm getting massive tax losses and deductions that I will not get in the stock market typically. I'm just not going to get it. And the appreciation is definitely on most stocks pretty strong. If I take a conservative buy and hold deal in a C-class neighborhood and compare it against a conservative blue chip stock, and is this going to double in value or not? I don't know. I'd have to run that. That might be different, but I would say real estate, it also puts the cash in your hand today, especially as a buy and hold strategy. I think real estate crushes the stock market, and it's more predictable than what a stock is going to do long term. Less market factors on a rental property. Any thoughts on pairing business credit as your 10 to 15% down with hard money for the burst strategy? The hard money lenders are going to look, right? They want you to have some capital. Like, especially the more leverage you get from a hard money lender, you have to understand a lender lends to somebody who looks like they don't need money. That might be counterintuitive if you heard that for the first time, if this is the first time you're hearing that. But lenders lend money to people who look like they don't need it. So if you're coming to the table and you're like, I can get the 15% off credit cards and this, and they're like, bro, how much cash do you have? And you're like, well, I got 5K. You look like you need money. You might have credit lines and liquidity, but you look like you need cash. And that's not necessarily the best way to present yourself, in my opinion. Ricardo just tapped into the DIY program. Is co-living a viable option in Philly? Have you done many? I've done over 100. I've done over 100 co-living. We're doing it right now. It's very viable. It's very profitable. I actually had, this is a good story. I was telling somebody this story. We had a co-living property, and the owner of this property knows. He's in a Boots on the Ground program. We had an inspector come in, and they were trying to get into this property for 6 months. Like, they were maybe less, maybe 3 months, 4 months. And they just had like a hunch. I feel like, I want to get into this property. I want to see what's going on. It had an old violation that should have been resolved from the rehab we did and the permits we pulled. So they come into the property, and it's set up as co-living. Oh, they start, I'm shutting this thing down. Everybody will be out of this property in 24 hours. I'm putting violate. It was like the Denzel King Kong scene in Training Day. I'm putting cases on all y'all. Like, it was just like, she's going off. And I'm like, we'll see. I'm not budging. And I think the owner is kind of like, Brian's a little too cool right now. But I'm just like, I'm not impressed. I gave it 48 hours. I knew it was bad for her when the 24 went by. But I gave it 48. She comes back, well, just put some trash cans in front of the house. And that was it. Because with co-living, we're doing it above board. We're pulling all permits. We're building to code. We're not violating the housing or zoning regulations when it comes to what qualifies as a rooming house or a group home. We're not going to do that. We're not here to get in a fight with anybody. We're here to create quality, affordable housing for people who really need it in a compliant way. That's what co-living is. So it's 100% a viable option in Philly. It's viable in Baltimore. It's viable anywhere where people need affordable housing. It's viable. You just have to do it legally in the right way. And that's what we teach and that's what we preach. The only way to scale your real estate operation is to do it above board in plain sight. It's very difficult to scale, to do 10 deals at once, 20 deals at once, below the radar. And you don't want to scale something that an inspector can walk in the door and just slam you like that. You want to build it. So what happened with us is what happened. They came in wanting to slam us. Then they talked to their boss and they said, no, they pulled permits. Here's the city stamps. It's legal. How many units were there? Well, there were 3 people in there. Well, they can rent it no more than 3 people. So what are you talking about? So sometimes inspectors lose sight of what their job is. Your job is to keep people compliant and up to code, not to go in and shut down affordable housing or, a co-living situation. If people want to co-live to save money, that's their business. Mind your business. Let people live. It's like sometimes these inspectors run in and they don't understand how hard it is for people out there. They got a good job as a city inspector. They got benefits, pension. People are living hard out here. Sometimes people are working, just pushing Uber and hustling a couple of side gigs to bring in $3,000, $3,500 a month. And when you're at that level, you're bringing in 28, let's call it 2,500 to 3,500 a month. You need something affordable. You need some affordable housing. So co-living provides that. That's why we love co-living. That's why I recommend building it. I'm going to keep building it. And it's the best thing since sliced bread. To me, it's the purest solution to the affordable housing crisis. And I'm glad that the inspector came in and put their foot on our neck and battle tested what I've been talking about, which is it's compliant. What are they going to tell us? They stamped it. So that's how you guys want to roll. So guys, hope this session helped. I don't want to keep you guys forever. If you're interested in the real estate ride along, May 18th, DM me or click the links in the YouTube video description. There's a link where you can grab your ticket. There's only 1 or 2 left and it's sold out. So definitely grab your ticket. If you're interested in the Boots on the Ground program, you want me to just build a house for you, build me co-living, Section 8 me something, give me some cash flow, reach out to me and my team. We're only going to take on maybe another 2 people at the moment. And then there's the waiting list. If you get hit with the waiting list, you will have that opportunity to skip the line with the Skip the Line program, where we'll just grab you one of these bank-owned deals and hand it to you. And, you can be in a deal in a matter of a couple of weeks and quick to the cash flow. So you can reach out about the Skip the Line program if you get beat over the head with the waiting list because you move too slow on the Boots on the Ground program. And then you guys can always tap into the do-it-yourself course. If you're a do-it-yourselfer, or you just want to dip your toe in and kind of learn these advanced strategies of how to wholesale, how to do subject to and creative financing, how to buy and flip, BRRRR strategy, buy and hold, deal with tax liens and tax certs, buy from the auction. If you want to learn all of this stuff and get to that mastery level where you can get to the next level, reach out, DM me, email me, click the links in the description, book a call with me and my team, and get tapped into our DIY course where we can kind of build you up in the group coaching setting as well. You guys know the Boots on the Ground program is where we have all those, one-on-one Zoom calls and phone calls and texts and all that stuff where you just have full access to me and my team. So if you're looking for that high level of full access, Boots on the Ground program is where you want to be, or Skip the Line program and try to just jump in and get a deal, get some cash flow going, and then get to the next level. So hopefully this helped, guys. Brian Grimes, your real estate mentor. I'll see you on the next one. And that'll be on Wednesday, 12 p.m. Pacific, 3 p.m. Eastern. I'll see you guys.